I want to welcome everybody on behalf of all the organizers and everybody that is attending this online conference dedicated to the impact of pandemic shocks on institution, markets, and behavior. I give you an advice. Sit comfortably on your chair and you will spend the next couple of hours or more with us. Unfortunately, the COVID restriction enable us to host the seminar at the Museum of Saving Premises. However, one of the positive legacies of the pandemic is the increasing familiarity of virtual meetings. And despite the technical hitches, we'll all appreciate the possibility of expanding the number of participants without too many restrictions. Today online, there are more than 250 people. I thank the Herbert Simon Society and Professor Riccardo Viale in particular for involving the museum in this project. And I'm also very grateful to all the speakers for sharing their precious points of view on the matter. The conference will be opened by Dr. Salvatore Rossi in his capacity as a chairperson of the HSS Scientific Committee. Then 3 sessions will follow. The first one is about the lesson we can conjecture for the future and deduct from the past. The second is more operational, as it analyzes whether markets provide evidence of positive elements ahead. The last session instead addresses whether the new normal will bring about new rules from supervisory bodies. And finally, Gregorio De Felice, who is the chief economist of Intesa Sanpaolo, will have the difficult task to conclude this conference. Given the richness of the program, I would rather keep this preamble short and ask everybody to stay within their time limits. So I will launch the video recording of Salvatore Rossi's introduction.
Good afternoon, ladies and gentlemen. It's a real pleasure and honor for me to introduce today's seminar on pandemic shocks, financial institutions, markets, and behaviors. As you know, it's the 4th seminar organized by behaviours, an initiative born a few years ago to promote and collect studies on behavioral financial regulation and policy. Let me start with a few words on the COVID-19 pandemic. The economic and financial consequences of the pandemic are proving to be catastrophic all over the world. Already in April this year, just after the peak of the first wave of the pandemic, the abyss in which the world economy was precipitating appeared horrifying. I wrote an article on this subject in the Italian geopolitical magazine Longitude, from which I will take some thoughts today. The first wave of the pandemic caused a sudden collapse of aggregate supply in most economies. Factories and offices closed because workers were forced to stay at home. Aggregate demand followed suit. Those staying at home considerably reduced their consumption. Entrepreneurs postponed or cancelled their investments. In the summer, the pandemic receded and the economies recovered. But we are now in the middle of a second wave. Containment measures have been hardened in most countries, and the economies are suffering again. A steep backward step is being observed in the national product of every affected country. The International Monetary Fund, in its World Economic Outlook, published last October, projected a fall of world GDP between 4 and 5% this year, as a result of a 6% drop in advanced countries and a 3% decrease in emerging and developed ones. It would be the first ever global synchronized recession. Still, this may be a rather optimistic view in light of the fact that since mid-October, when the outlook was released, the pandemic has been continuously ravaging most countries. Anyway, we are talking about figures never seen in times of peace. For Italy, the projection is close to 10%. Such unprecedented global exogenous shocks are diffusing fear and impoverishment among the world population. They raise the question of how and how much behaviors may change in response. Finance, notably behavioral patterns by financial intermediaries, markets, borrowers, savers, may be particularly affected by the pandemic and may experience severe disruptions. Let's clarify an important point. If the collapse of economic supply and demand, though dramatic, lasts a few months and it doesn't cause permanent damages to the productive structure, thus allowing our economies to restart as or better than before, collective well-being would not be permanently compromised. Even financial systems would be rocked, but in the end they would absorb the shock. The true drama would occur if, during the partial stop of production and consumption, mechanisms are put in place which inexorably amplify and prolong the depression. Layoffs, bankruptcies, insolvencies, precautionary saving, panic. They may permanently change the behavior of all the economic agents with profound consequences on financial circuits. Simply put, the risk is that precautionary saving will skyrocket, but investment opportunities will be rarefied, since less and less entrepreneurs and households will want to borrow. The result may be, among other things, a paralyzed financial system. To avoid all this, public spending had to intervene. Nobody disputes that, not even the most conservative thinkers. At such an extreme juncture as the one we have faced since March, governments must build a bridge over the abyss and guide the entire economies of that bridge, pay salaries on behalf of private employers, covering any additional costs that a business must maintain in order to stay open, supplies, bills, even if for a few months it won't sell anything, ensure banks that their debtors are guaranteed by the state. How much money is needed to build the bridge? A lot. Supposing that is equal to the lost GDP, in a country like Italy we are talking about between 150 and 200 billion euro this year. Public debts are increasing by as much. Until now, there has not been an issue of sustainability, not even in countries where the public debt was already very high, because of the providential interventions of central banks. For instance, the European Central Bank has enormously increased the scope and the volume of its unconventional interventions. In a nutshell, the mechanism at work is the following. Governments spend, issue bonds to finance themselves, and auction them on the market. Investors know that the ECB is ready to buy from them any amount of public bonds and thus accept low interest rates on new issues. All of the above is in regard to the state of emergency we are currently living. Once the productive system and the social fabric of our countries are safely carried on the other side of the abyss, the attention should shift to restarting. What should be the priorities of economic policy in the coming months of hopefully gradual normalization? Two priorities stand out as fundamental. One is restoring trust in the growth prospects of the world economy. The other is laying down public infrastructures fit to support a different kind of work organization. The first priority is above all international. In particular, trade must remain free all over the world. The instinctive reaction of national governments when faced with an exogenous shocks of this amount is to close the borders. Though understandable, it must be resisted and reversed. International cooperation is key when the shock is perfectly symmetric and hits randomly here and there. To understand the second priority, we must be aware that life after the pandemic will be different in many aspects. First of all, in the workforce. For instance, the imposed habit to use smart or agile work that many of us have acquired in the last months is bound to become a permanent feature of many businesses, even in the manufacturing sector, simply because it is more efficient. Ladies and gentlemen, we are living in tough times, but we should not despair. Finding the right policies, economic and financial in particular, to fight against a new and unknown enemy is a difficult exercise, especially in democratic countries. This is why it's essential to continuously analyze the battlefield and exchange informed views with a multidisciplinary approach. We must know the enemy and the damages it can inflict in order to win the war. Thank you very much.
Thank you very much, Giovanna. Allora, I wish to begin with a thanks to Museo del Risparmio. I want to use the Italian name for the organization with the Herbert Simon Society of the seminar, with the support also of Collegio Carlo Alberto and of the Behavior Insight of Bicocca University. And with the support also of Intesa Sanpaolo and Banca Aletti Allianz. The topic of the two key speeches is about theoretical problem in economics to deal with pandemics. I want to introduce the topic with the words of Jim Savage, the great Jim Savage. When we decide, we have in front of us two kind of environment. One environment, we don't know how many alternatives there are. It is unclear what the consequences might be and how estimate their probability and utility. This environment is called large world and is characterized by uncertainty. Instead, the other environment where we may decide is in contrast theoretical or predictable without surprise and is characterized by the knowledge of all relevant variables and their consequences and probabilities. Science, what is the role of science? Science aims to transform large world problem into small world problem when it's possible. But this is possible only when large world problems are characterized by what is called epistemic uncertainty and not by fundamental ontological uncertainty. The first kind of uncertainty occurs when, ideally, empirical research and collection of data are able to supply statistical figures that characterize relevant variables, their consequences, and probabilities. The second kind of uncertainty deals with events that empirical research is not able to represent probabilistically because of complexity or unpredictable surprise. The first kind of uncertainty usually applies to most biomedical research, for example, trial for a new vaccination, whereas the second applies to macro-political, environmental, and financial phenomena, for example, the prediction of a financial crisis. COVID-19, like many other infections, is typically characterized by epistemic uncertainty. In few years, we hope, biomedical research will be able to define its viral behavior and possible treatments, ceteris paribus with likely mutation, obviously. On the contrary, financial markets are typically characterized by ontological uncertainty. None might predict their future behavior. Unpredictable surprises are unknowable, and the COVID-19 was one of them. And the question then is, the question of this, of this summit, how can we cope with the financial effect of this infection today, and what kind of financial policy making would be preferable? How should financial institutions deal with the effect of a pandemic to maintain financial stability? How may markets react to unmanageable, unpredictable pandemic shock? And how do human financial behavior adapt to pandemic uncertainty, and what kind of changes and innovation they are pulling in the financial system? Obviously, there are many different answers. A possible answer that is supported by many of us at Herbert Simon Society is to forget traditional rational approach as value at risk, that is common in a financial assessment, and to follow heuristic decision-making, bounded rationality, and the principle less is more. And I think this is my small introduction is connected with what Herr Schäferin will tell us. Speech, the title of his speech is The American Experience of Pandemic Economics, Looking Back, Looking Ahead. Herr Schäferin, I tell also some about his biography. Schäferin at the University of Waterloo in 71 received Master of Science in Mathematics. He then obtained a PhD in economics from the London School of Economics in 74, after which he became assistant professor at the University of Rochester. In 79, he was appointed professor at Santa Clara University, first in the Department of Economics, and then in 90 in the Department of Finance. And what is important, he has long-standing collaboration with Richard Taylor and Mayer Statement on behavioral finance, being one of the first economists to have incorporated the idea both from psychologists like Amo Tversky and Daniel Kahneman, and from also the approach of Gergi Gerenzer, ecological rationality, and what is common to Herbert Simon Society activity. He is also vice president of Herbert Simon Society. His book, a very important book, Beyond Greed and Fear, Understanding Behavioral Finance and the Psychology of Investing, and a behavioral approach to asset pricing theory, behavioral corporate finance, and two seminal articles. One in 81, an economic theory of self-control with Richard Taylor, published by the journal Political Economy, and the second, behavioral capital asset pricing theory statement in the Journal of Financial and Quantitative Analysis in 1994. Please, Hersh, you can start.
Hersh, just a moment, you have your microphone off. Okay, let's start.
Thank you so much.
Okay, perfect.
All right. Thank you so much, Ricardo, for those very kind introductory remarks. It's a real pleasure for me to be here with you today. Let me just share my presentation. All right. So I'm hoping that everybody can see the title slide of my presentation. So I want to give you a sense of the American experience today, but begin by taking a look back at COVID-19 deaths before the current surge across several countries. So what we have is a trajectory of cumulative deaths from COVID-19 across several countries. I've highlighted a couple of them in heavy lines. And so the red corresponds to Italy, and the blue corresponds to the United States. So these are deaths per million capita. And so what you can see is that Italy and the US, just before this current second or third wave, if you like, began, were actually fairly similar in terms of number of deaths per capita, but the trajectories are very different. Italy peaked earlier and then reached a plateau, flattening its curve, but the US has really never been able to do so. And both of them are pretty much close to the top in terms of the range of countries when it comes to COVID deaths per capita. Now, if we look ahead, when we look ahead for the projections for what is in store for Italy, you can see that we have a flattening of the curve that will likely occur sometime at the end of February or early March, assuming that the virus, assuming that the vaccine is delivered efficiently and promptly. And in the US, you have something that is a little bit less favorable because the future looks a little bleaker. There's several possibilities. One is that the red curve that you see off at the right shows what would happen if the US fails to contain. The best predictions are in the middle and are associated with what happens if the vaccine is delivered efficiently. It doesn't make that much of a difference in the short run. The fact that the vaccines began to be administered yesterday, unfortunately, won't have an effect for several months. It's hardly discernible. And then the lower curve is what would happen if the US adopted universal masking policy, where virtually everybody wore a mask, and Americans seem to be reluctant to do so. So that is an unlikely prospect. All right, so let's take a look back now at what happened in the US last March. So last March, there was this sudden realization that the pandemic had reached the US shores and was going to be a serious issue. We had learned from the experience of Italy that the virus had reached the West. And in March, the Washington Post pretty much told us, as soon as the labor markets responded rather chaotically, that we were at the beginning of another depression, another Great Depression. And that was certainly true in terms of what happened in the labor markets. And so the little graph off to the right shows you the unemployment rate trajectory across several past recessions. And what you can see is that the unemployment rates, do have a little blip when you begin a recession for most of the previous recessions, but nothing that like at the right of the screen, which is what we experienced last March. And so we had the possibility of a real depression looming before us last March, with huge unemployment and therefore a huge negative shock to the supply curve. So what would happen if we looked ahead and another Great Depression were to have unfolded? So what we would have seen is that if you look at the trajectory of US GDP from the beginning of 1999 through up for the first 30 years of the 21st century, this is what would GDP have looked like in terms of the dotted lines on the curve show you what GDP would have done if we repeated the Great Depression. And what you can see is a very, very sharp contraction in GDP and a prolonged recession that would be very deep, with a second wave somewhere along the line. Now, I wrote last April that in a piece called Great Depression Economics 101, I wrote that although we started off in a way that was similar to what happened in 1929, we had the advantage now of almost a century of insights about how not to have to experience depressions in terms of economic policy, mostly based on the work of John Maynard Keynes. And I just want to pick up on a remark that Ricardo made. So Keynes in the 1930s put forward a new paradigm of how to think about macroeconomic stability, where he challenged conventional economists who had a very neoclassical view of the world. And that neoclassical view held that most people are rational and assume pretty much perfect rationality on the part of major economic decision makers. And Keynes, I think, was really the first behavioral economist since Adam Smith. And his framework took into account the imperfections in human decision making. He was a real predecessor relative to in terms of Herbert Simon. He didn't use the word bounded rationality, but if you read his text in terms of this book, what you see is the same similar language. And he gave us a bottom line in terms of what you need to do to avoid a recession turning into a depression, which is use fiscal and monetary policy sensibly to prop up consumption, investment, and government expenditures. And so that's what's been happening in the US this past year. Enormous government spending, $2 trillion in something called the CARES Act. The CARES Act stands for Coronavirus Aid, Relief, and Economic Security Act. And the central bank has brought interest rates effectively down to zero. Both of those were strong Keynesian prescriptions. So if we look at the trajectory of what's happened in 2020, what we see is that if you look at GDP growth, it was quite stable until the beginning of the year, and then it dropped off very sharply in the second quarter of the year, and then in the third quarter of the year, it started to come back in what's been called a V-shaped pattern or V-shaped recovery. So where are we today? So today we're in the midst of just about to have a new presidential administration, but there's still debates taking place about how much stimulus to provide, and there is actually a great difference of opinion that has emerged, creating some uncertainty. The Treasury Secretary, representing the administration, has one view, and the central bank, represented by its chair, Jerome Powell, has a different view. It's very interesting to think about the nature of the difference. Effectively, the administration thinks that it's important to maintain economic recovery and not to have lockdowns or containment measures to deal with coronavirus, COVID-19. And the Fed says, it's important to have lots more stimulus than the administration wants because there's still a lot of uncertainty. And that uncertainty, manifests itself in terms of nightly uncertainty, what Ricardo mentioned, the difference between uncertainty and risk. We really don't know the probabilities, and therefore it's prudent to be cautious. So probably the most important thing I want to share with you today is work that was done in April by economists, and you see their names at the top, Eichenbaum, Rebello, and Trabant, and they proposed an integrated model. Oh, I'm so sorry, let me just go back. They proposed an integrated model for how to think about what's happening on the epidemiology side, which is the virus and the pandemic, and the macroeconomic side. And so theirs is a model that incorporates the coevolution of the economy and the pandemic. Now, what's interesting about their framework is, and I've used this model to really guide my thinking throughout this entire pandemic, is it's based on the idea that we typically have to figure out how to trade off economic benefits with protection for life. And it's the value of life approach. It's not perfect, but it gives us a sense of how to think about the trade-offs in question. And so if we contain more, then we can reduce deaths, but we'll also reduce economic activity and lower GDP. And so the question is, what is a sensible trade-off? And what this framework does, it gives us a sense of how to evaluate policy in this situation to come up with something that's reasonable. So if you look at the two graphs that I presented from their model, one is cumulative deaths, and what you have are three curves, a blue, a red, and a dotted black. The blue curve is what would happen if there was basically no containment. We simply ignored the pandemic and let the virus spread until we got herd immunity. And you can see deaths are highest, but you get the end of the pandemic earliest. The black at the bottom is what would happen if we try to follow a semi-sensible policy. And you can see that you have lower deaths, but the pandemic lasts longer. And then you have a case in the middle, which is where we are slow to respond to the virus, but eventually do. What happens is the corresponding GDP behavior pattern occurs on the right, and you can see that you wind up having the least impact on the economy if you simply ignore the pandemic. And it's most difficult if we have a late start, and then the dash case is the middle. Over on the right, I just want to show you that if you take a look at that black projection, which was sort of the best case presented by these three authors, those curves have pretty much traced out since last March the way that the economy has evolved. And so today, the model predicted that the number of deaths in the US from COVID-19 cumulatively would be 297,000. And yesterday, we passed 300,000. That was very close. The other numbers before were also pretty close. And the 528,000, which is the forecast for the 1st of April, 2021, is very close to what the University of Washington, the most respected model in the US at the moment, is predicting. So this particular framework I have found to be really quite accurate as you could hope for a situation featuring this much uncertainty. So looking ahead, in terms of financial markets, so I'll pick equity markets just because they're the most dramatic. If the Great Depression were to repeat itself, then in terms of earnings and stock market activity, the S&P 500, this is what you would see for the next 10 years. The past is shown by the solid curves and the dotted by what would happen if the Great Depression repeated itself. That's what we would see. But over the last year, that's not what's happened. So Bob Shiller, who I think is probably the most astute observer on overall pricing for equity markets, he wrote a piece that appeared just 2 weeks ago, where he suggested something quite different what he said in the past. In the past, he's used his cyclically adjusted price-earnings ratio to suggest that markets are typically overvalued. But in today's environment, he actually suggests that this isn't the case. His bottom line is actually be reasonably priced at the moment. And so why is that? So it's largely because investors, he says, have become much more familiar with the nature of the shock. So the fear factor has reduced itself, and as equity markets started to go up, there was a fear of missing out. So investors actually moved back into the market more quickly than they would have. They're heartened by the V-shaped recovery, and they're heartened because vaccines have emerged and are starting to be administered. So the basis for his conclusion that the market might be reasonably priced is he computes something called the equivalent CAPE yield, which is the inverse of the PE ratio, earnings to price, so it's an expected earnings yield, and you subtract off from that the real interest rate, so it's a premium, and then real interest rate at the moment is negative, so negative 1%. So the equivalent CAPE yield is as an excess return or a premium is about 4%, and he suggests that that's a quite a reasonable number. All right, so looking ahead, what is it that we could say, at least for the U.S. So there's reason for hope. There's reason for hope because given the nature of vaccines and the current projections that are coming out of the models, it might be that the pandemic will feel close to being over. I don't know will it be fully contained, but by late 2021 or around early 2022. And as far as the economy is concerned, that it looks as if the economy will feel close to where it was before the pandemic started, probably around early 2022. Now, I don't say those with great confidence. I just say that there's reason to be hopeful that will be the case. And as for financial markets, at least on the equity sides, they always continue to surprise us. So I'm very cautious about saying anything about equity markets. But at least I think that there's something to look forward to with some optimism. So with that, I will thank you for your kind attention and turn things back over to Ricardo.
Thank you very much, Ersh. With this expectation of optimism that we need a lot in Europe now, and this your speech that is a speech about the future may be properly connected to a speech about the past that will be the speech of Donato. That will the title is Pandemic, Recession, Economic Policy and Money, Tales from Serenissima. Serenissima is the nation republic that was a political power in the past in Italy, one of the most important trade political power in the past. And Donato Masciandaro is full professor in economics at Bocconi University, is as a chair in financial regulation at University of Bocconi, has been director of the Department of Economics from 2008 and to 2010, and now from 2013 to today. Since 2015, has been president of BAFFI, Center for Applied Research in International Markets, Banking, Finance and Regulation. Is now a member of the management board of Société Universitaire Européenne de Recherche Financière, has been a visiting scholar at International Monetary Fund and advisor for the Interdevelopment Bank and United Nations. He is associate editor of the Journal of Financial Stability. His main area of research are financial regulation and supervision. Now the floor to Donato.
Do you hear me?
Yes.
Yes, perfectly.
Oh, perfect. So first, let me start from the procedure. So let me share with you my presentation. Okay. Okay. Do you?
Yes, yes,
see?
it's okay.
Oh, perfect. First of all, Let me thank Giovanna, if I may, and Riccardo, here I may for sure, to invite me in this really interesting webinar. And so far by Hirsch, if I may, we told us a story of past, futures, present, past and futures, but my past it's very old. Which is the motivation of this speech. The motivation is just let me start from a definition that Christine Lagarde gave on the present COVID recession. She said this is definitely an unconventional recession. And why? In a nutshell, given that Hirsch gave already a nice and complete description of the story, in a nutshell, given an economy, we can distinguish three sectors: aggregate demands, aggregate supply, and banking and finance. And usually we can say we are in a conventional recession with the trigger is in one of these three sectors, and then we can have, it is likely to have a contagion effect in the others. From this point of view, definitely the COVID recession is spatial in the sense that the trigger is outsider the story, in the sense that the trigger is the mix that really well described, is a mix between pandemic with health policies, and this trigger is simultaneously aggregate demands and aggregate supplies, and crossing the fingers, so far we have no second round effect into the banking and financial sector. So definitely a spatial story, but a natural question arises: is this COVID recession also a unique story? And here the answer is definitely no. And here comes my short, I hope, and I guess, story from the Serenissima. Let me just say you that I give just a sum up of a story that we are writing with Charles Goodhart and Stefano Ugolini in a paper. And what we did, basically, our story is a story of a pandemic recession that occurred in Venice during the year 1629, 1631, when the Republic fought first the famine and then a plague pandemic. In order to appreciate how the story can be useful for this meeting, let me just record which was the relationship between Venice and the pandemic. Venice implemented its first legislation to address a plague epidemic in 1333, and an act office was established in 1390. And in this year, Venice developed a strategy along three trajectories. First, try to prevent its originating in Venice. Two, to impede its importation. And three, to check its spread should it break out in the city. And so in general, during the plague episodes, the Republic imposed a general blockade on all neighbors suspected of the plague. The containment measures, our lockdown, were carried into effect on a colossal scale with full resources of the state. And at the time, in this occasion, the trade-off between health and economics that Hirsch described a few minutes ago eventually emerged. In which terms? Let me just describe this trade-off in Venice. For example, during the 1576 pandemic, the Venetian government reacted in a very slow way. First, denying the plague, and then downsize the number and the natures of the death. And which was the motivation? Politics. Let me give you just a couple of examples with a couple of quotations. A merchant pleaded for the quarantine to be lifted, given that, quoting, an incomparable greater number of people has died purely as a result of unemployment than of fevers or any other contagious disease. So, which was the problem? The problem was a consensus on the fact that the Republic territory was suffering more from the ban than from the disease itself. And so the population was watchful of the activity of the government and was ready to riot and tumult if they become convinced that the government was not doing all it could and should have done to ensure the availability of food, guaranteeing the right, quoting, the right of bread. Now, given this trade-off, which was the reactions of the Senates of the Republic? The reaction was some things that we can call, with a modern wording, a fiscal bazooka, in the sense that the Republic moved two arms. On one side, fiscal transfer. In fact, during the pandemic, the government bought necessary goods from the merchant. In fact, when city districts were put in quarantine, the inhabitants were provided by the states. Moreover, poor laws were promoted in order to reduce the risk of disease. On top, the Venetian government influenced employment and nominal wages in the sectors under its direct, total or partial control. Let me give you just an example, the arsenal wages. The government, quoting, in its anxiety to prevent so vital trades from decaying, was accustomed to pay its workers some things, even if there was nothing for them to do. So one arm was fiscal transfers. On the other side, there was public spending. For example, again, during the 1575 pandemic, a program of public works in order to give the unemployment people a livelihood was considered. At the end of the day, which is the bottom line of this narrative, on the one side, the politicians have to trade off health versus economics. And so in order to address and try to fix this trade-off, in order to maintain or to increase the consensus, they use a fiscal bazooka. This in general, but let me zoom in on the 1630 episodes. First, which were the causes. From September 1613 to September 1631, Venice was hit by a bubonic plague that can be considered a sort of Black Death-like event. It was originated in Northern Europe in 1633, and this pandemic crossed the Alps in 1629, and in the case of the Republic of Venice, likely carried by imperial army on their way to Mantua. In general, look, this was a common story. There was this three apocalypse horsemen in action: war, famine, and epidemics. In fact, in 1629, the Republic has already coped with the famine, where extreme hunger has been one of the hands correlated with war, and on the other hand, with the plague. At the end of the story, a massive outbreak took place. Look, just to give you some figures, the population of Venice suffered a reduction of nearly 30%. And just to give, a metrics, these figures should be compared with estimated average annual mortality in normal time, I would say, between 3.7 and 2.7. Was a really was a really shocks in terms of demographic consequences. And let me just to give you the overall story, 5 others information. First, the more younger people from 70 age group seem to be relatively more spared. Secondly, the upper classes, nobility and civil servants, seems to be less affected by the epidemics. The percentage of females became greater than that of males. Plague seems to have led to a substantial increase in the marriage rate during the decade following his. Last but not least, while there was a tendency for family to be smaller, up to 4 members than were those before the plague. We can also take in mind these metrics to do this comparison, some comparison between the whole, very old story that I'm telling you and the today's situation. But let me coming back quickly to the policy. What the Senate decided to do? Use the bazooka. Okay, done, but how to finance a fiscal bazooka? In order to appreciate what the Republic did, let me just recall you that Venice at the time reached a degree of monetization definitely unknown for centuries anywhere else. In terms of money, the citizen of Venice used 2 different money. On one side, coins, i.e. commodity money. On the other side, bank transfers, even for the lower middle class. So, in terms of public money, we have 2 different kinds of public money. Commodity money, i.e. coins, and from 1587 to 1630, also convertible money, because in Venice there were 2 subsequent and overlapping public banks. Let me call these 2 banks, for the sake of time, the Rialto Bank and the Giro Bank, are subsequent, overlapping in terms of periods and also in terms of partially in terms of business. On one side, we have the Rialto was a sort of just a deposit bank, we call narrow bank, while the Giro Bank was de facto a device, a tool to make the public debt easily transferable in Venice, turning debt into a means of payment. At the end of the story, 2 public banks in action. Look, today in the modern time, we discuss about the independence of the central banks and the likes. Definitely in Venice, we have a fiscal dominant regime. In other words, the government, the Senate fully control, perfectly control the two banks. So given this background, what the Senate did, essentially, they used 2 devices. On one side, taxes, in order to address the increasing public expenditures due to containment policy needs. Whereas instead of normal taxes, given that the tax collection was more difficult to implement. But on top of that, the Senate implemented a sort of what we can call, in a moment I explain one, a sort of monetary helicopters. Translation, started to print money in a very aggressive way. Just to give you again some metrics, consider as a target in normal times in terms of money supply of 800,000 ducats. No, in order to finance the fiscal bazooka, the Giro balance sheet reached a peak of over 2.6 trillion ducats in June 1613. In other way, the monetary policy stance moved from normal times behavior to extraordinary behaviors in order to finance this fiscal expansion stance. And which were the consequences? This overexpansion, without no surprise, triggered a huge monetary depreciation. At the end of the story, what you know, the more you're printing money in a system in which there is a convertibility promise between paper money and commodity money, there was the collapse of the convertibility promise of the Giro banks. And this was, you know, the cost of the story was not so low. Again, using modern wording, the Republic came back again to a new normal times just in 1638, when they were able to stabilize the Giro balance sheets. Why this is an helicopter? This is an helicopter because we have some things, we have an action that is quite common in the modern debates. In the modern debates, there is this extraordinary monetary policy action that was born as a metaphor in 1969 in an article wrote by Milton Friedman. That he did this metaphor just for pedagogic reason, but at the end of the day, which is this extraordinary monetary expansion? We have on one side printing money, really extraordinary expansion in terms of liability, public liability. On the other side, you have losses in the balance sheets of the money issuers. And in fact, in this story, what we have that the Republic, at the end of the story, implemented this mix between fiscal bazooka on one side and helicopter money on the others. The losses in this case were unintended, while in the modern definition, the losses are intended one. But more important, which were the reasons of this extraordinary means? Political reasons. Try to avoid riots. Try to maintain the consensus. And record, in the Serenissima, the monetary lever was completely under the control of the government in charge. A good news for you, this is my last slide. Which can be the takeaway of this story, this very old story? Let me offer some personal insight or reflection or consideration. First, from a methodological point of view, I think that it's really important that history and economics go hand in hand. Or I would say two reasons. It's a sort of a two-way road. On one side, historical events, as the tale of the Serenissima, can be useful for evaluating current macroeconomic events. On the other side, modern economics and political economy as well can provide consistent framework setting to analyze historical facts. Secondly, my feeling is that after reading this very nice paper on the Serenissima, I guess that we can say that some events, true, are unconventional, are not normal, but are not completely unknown. Let me just, stress at least three different issues on this point of view. First, seems to be true that pandemic recession is likely to have inequality consequences. Secondly, again, Also in this whole story on the Serenissima, we feel to have the trade-off between health in economics, which characterize harsh speeches and also my reflection. Let me say the trade-off between health and economics is not a story which is definitely over, because let me wonder, it is a real story or is it just a perception? There are a recent paper made by Fernandez, Villaverde and Jones, National Bureau of Economics, 2020, that casts some doubts on these trade-offs. Third, in this old story, we found out some modern situation. Fiscal containment, taxes, helicopter money. Third and final reflection. When we discuss about economics and policies, we have to use history, economics, traditional economics and behavioral economics, but also political economy, because at the end of the day, who are the players that move the games? The politician. There was the Senate into the Serenissima tales. Today we have the government in charge. All in all, I think that can be interesting, and in some cases fun to mix history and economics, to use the history. Let me conclude smiling. I think that we can avoid the misuse of history. A few days ago, I read about a comparison between my story, better the pandemic, the 1630 pandemic and the today pandemic, noting that in both here there's this rare events, i.e. the conjunction between Jupiters and Saturn. This seems to me a misuse of history, but perhaps it's just my perspective. Thank you for your patience and your attention. I hope that I could offer you some food for thought. Thanks, Riccardo.
Thanks, Donato. I was fearing that you were following Trump, that anything goes. Okay. Now is Umberto or Giovanna that is chairing?
It's Umberto. Here it is.
Umberto, now give the floor to
Tim.
Yeah, actually, the problem was that I was afraid I couldn't get on time to this webinar because I have, a last-minute problem. But here I am. So, first of all, thank you to everybody. Thank you to Hirsch and Donato for this, great picture that they gave us. From future to present to past, and of course, maybe history is not always. Must not be misused, as Donato was saying, but it tells us something about what happens, and it gives us, as you said, food for thought. We now go into the second session of this webinar. The title is Something Good in Sight. Actually, we hope that our speakers will, erase the question mark. Saying we really hope there is something good in sight. We have a very rich panel of speakers, and so I will just be the announcer. Sorry, I don't feel I have to have the right to steal time to very interesting things that they will tell us. So I will just introduce each one of them. Starting from our keynote speaker, which is Corrado Passera. Corrado Passera is the CEO and founder of a limited bank Before that, I mean, his cursus honorum is very long, so it's Intesa Sanpaolo, it's Ministry of the Economic Ministry, Poste Italiane, Banco Ambrosiano, Olivetti, and probably I forgot many other things that he has done in his very intense professional activity. So, Corrado Passera, the floor is yours for your keynote speak.
Thank you very much, and thank you very much for inviting me. I was asked to look at the topic of this seminar through the lens of companies, focusing on the impact of pandemic on company behavior, and in order to understand the attitude of companies during this kind of in this kind of situations towards innovation. I do hope that by the end of my speech, we will all see that something good is actually in sight. The pandemic added increased uncertainty to the already growing uncertainty faced by companies, and actually by any form of association and organization. The fear and worry spreading through society, especially the most vulnerable sections, is tied to these growing areas of uncertainty. For example, peace. Peace is threatened by increasing political tension. Growth is threatened by the rise of trade disputes. Employment is threatened by the impact of new technologies. Welfare is threatened by the aging of population. And even the planet is threatened by global warming that is getting out of control. Uncertainty is undoubtedly the defining feature of the present time. Thus, as a consequence of it, the key issue becomes the management of uncertainty. I'll start with the direct experience we are enjoying at Illimity before providing another example of a totally different company. And I hope that these two examples will lay the foundations for some conclusions about the way companies could positively respond to the sort of profound uncertainty caused by COVID-19. The sudden outbreak of the pandemic in early 2020 clearly caught everyone by surprise, including Illimity. Many people around us believed that a new startup like us, like Illimity, would simply be wiped off the corporate map. This very direct existential doubt surrounding us was coupled with uncertainty about the new normal that would follow, and inevitably to be different to the old normal. But how would it be different? And how different would it be? We still do not have the answers to these questions. At Illimity, our management team, the top management team, immediate response was to try to ensure that all our employees remained healthy and relatively calm. And that led us to the decision to opt for 100% smart working, which was obviously facilitated by our fully digital model. While adopting smart working, we also emphasized the continuity, operational continuity, and getting everyone involved and on board. It was a tricky time, but it provided an opportunity for our Illimity identity to shine through even stronger, and also made our team closer. The business outlook was shrouded in uncertainty. Some activities were literally blocked, but this initial shock was short-lived, fortunately. Activities soon came roaring back to life, and throughout our organization, new hubs emerged that saw such rapid changes in various parts of society and the economy as an opportunity. Our various divisions launched new initiatives, some of which have already been made public, and we have even completed an important joint venture that created the leading open banking platform in our country. In short, we managed the uncertainty. Look, the lockdown might have restricted physical movement, but it created room for lateral thinking and provided an opportunity for entirely new projects. Let me be provocative here. We came out of lockdown in an improved strategic position and even more united. My guess is that it's no coincidence that Illimity scores for the best place to work even improved from 2019 to 2020. Our startup mentality and the highly digital approach made it easier for us to deal with uncertainty. But I think it would be unfair to say that our success was solely down to these two aspects, because I know, and we all know, other similar companies that did not necessarily do as well. I think there is another factor that matters, and I'll provide the example also of another company to explain it. This example is a case of significant uncertainty, sparking a process that resulted in profound innovation. I'm talking about Poste Italiane. In 1998, I accepted the role of CEO of Poste and Telegraphy, as Poste Italiane was known in those days. At that time, I don't think the situation of this massive organization, employing close to 200,000 people, could have been any more uncertain. There was uncertainty even about survival. The Prime Minister, that was Prodi at that time, and Treasury Minister, who was Ciampi, decided to offer this vast organization one last chance before deciding to liquidate it. And there was a lot of uncertainty about what the new normal would be for Poste, especially as it changed from a public entity, an ente pubblico, into a limited company, an SPA. What followed was an amazing story. In 1998, the Italian Postal Service was a symbol for inefficient Italian bureaucracy, with the worst mail service in Europe, and not only in Europe, awful P&L, and actually no future. And to compound matters, of course, there was no money available. I soon came to believe, to convince myself, that it would be difficult but not impossible to succeed in all the three main areas of activity: letters and communication, parcels and e-commerce, and financial services. And during this incredible transformation, it was confirmed to me that successful change management is strictly linked to identity. You can get an identity to evolve, but if you fail to respect the DNA of long-standing proud organizations, your change management will almost always be futile. We did our best to balance the old identity as a provider of an essential facility with a new identity as a successful and responsible logistics and financial service provider. How? Some of the main levers were obviously a top quality team, getting the best people from inside first and then from outside the organization. Setting a strong ambition. Moving mountains requires an achievable dream. And our dream was, unexpectedly for most people, to become one of the best postal services in the world and to create one of the leading retail banks and insurance company in Italy. Obviously, the culture had to be changed. We had to shift the focus from an accountability based on procedures to an accountability based on results, from an affiliation-based management to meritocracy. Big changes, a lot of investments in innovation, a lot of investments in human capital, a lot of external and internal communication. But in one organizational choice was crucial, and that has to do with today's discussion. We broke down that immense body into a number of centers of responsibility. Obviously, we had a lot of resistance to overcome. And that resistance were added, even made uncertainty bigger, especially in the early days. Trade unions, obviously, the dramatic increase in efficiency and productivity that was required partly had to be achieved by reducing direct workforce, around 30,000 units. At the beginning, the negotiations with the unions were quite difficult, but after a real effort from both sides, transparent negotiations about the business plan, the trade unions embraced the new philosophy. We definitely asked for very hard, very significant sacrifices, but we shared these sacrifices evenly across the entire organization and made them worthwhile. I don't want to mention the resistance we got from local and national politicians, from the traditional suppliers, but you can imagine all of that. It all worked, and in about 5 years, Poste Italiane became one of the best postal companies, reaching break-even, becoming a leading player in retail banking, insurance, logistics, and today, Poste Italiane is a successful, profitable, listed company with a number of international shareholders. Let's get back specifically to managing uncertainty. What is that factor that both a digital startup in 2020 and an enormous bureaucratic dinosaur 20 years earlier share when it comes to managing uncertainty? The factor is diffused leadership, which is really critical in managing complexity, especially when uncertainty makes the consequences of complexity even more serious. Complexity is the metastasis of organizations, regardless of size. Complexity comes from diversity, connectivity, interdependence, speed of change, new rules, overlapping of markets. I mean, we all know that. And all too often, all kinds of organizations, private, public, military, religious, academic, react ineffectively to complexity by introducing complex bureaucratic rules, complex governance mechanisms. If you add complexity to complexity, you simply create entropy that reduces reaction speed and brings paralysis. Empires that lasted for centuries and millennia were brought down by an excess of complexity. It is impossible to completely avoid complexity in today's world, but it can be managed through diffused leadership. You need to focus on a limited number of activities because excess of diversification can be deadly. You have to empower the heads of the different activities and make them accountable. Any decision needs to have an owner. Do away with excessive mechanism for developing the so-called synergies, for optimizing resource deployment, and for granting coordination. I'm talking about, for example, the organizational matrices that we all know. It's the classical example of how to create coordination and synergies. Diffused leadership is only possible by investing heavily in people. It necessitates accepting diversity, experimentation, and mistakes. The CEO and the top management body have to provide the example. I always say management by example. They have to give the examples themselves in their day-to-day behavior, and they have to demonstrate cohesion and in this kind of situation. And great uncertainty is really balanced by these kind of behaviors. At the end, people probably who are listening to me today and were hoping I'd come up with some new management formulas for success in the post-COVID world may be disappointed. But in trying times, such as now, a time that might even get worse, it is imperative to always remember the basics of leadership. Not only competence, responsibility, and holistic vision, but especially in periods like these ones, also a lot of creativity, change management skills, and courage. Such basics will always remain the pillars of good management. Thank you very much, and I hope I was not too long.
Thank you, Corrado, for your very interesting speech, which I mean, to me, I mean, it has a profound meaning in the fact, first of all, we must avoid complexity, and this in the Be Fairly initiative is fundamental, because we are simple and frugal, so complexity, we totally share your view. It's very often a way to mess up things, so it's important to go directly to the point. And the other, I mean, optimistic message that I got was difficult times, I mean, push you out of your comfort zone, and I mean, they force you to think in a different way, and while in nice and profitable periods is easy to make business, when it's difficult, you really have to find new solutions and find new options and new ways to develop new ideas. So I think this was trying to I mean, erase the question mark after something good inside. So thank you very much. After Corrado Passera, we have a number of other speakers, all very qualified. Again, I will just introduce them for their part, I mean, very partially what they've done. They all look at this, try to answer to our question from different perspectives. And the first one is Joyce Chang. Joyce is Chair of Global Research for JP Morgan Corporate Investment Bank. She has had a very, I mean, qualified career within JP Morgan. Joyce holds an MPA from Princeton and a BA from Columbia, and serves in its board of visitors. So I leave the floor to Joyce Chang for her speech. Thank you. Joyce?
Can you hear me?
Yeah, perfect.
Okay, great. It's great to be with you all.
Where is yours?
Joyce, we don't see you, so if you can switch on, okay.
Okay, great. Great to be with you. Thank you, Umberto, and thank you, Giovanna and Ricardo, so much for the invitation. So I'm going to cover our economic forecast, then talk a bit about the cost of the crisis and the longer term consequences. So what is there ahead? There is some good news ahead. We see global growth recovering to 5% next year, and we have Euro area growing 4.6%, the US growing 3.3%, and even coming out of the largest exogenous shock that we've really seen in modern history, we have the S&P 500, the US equity market at a fresh record high, and we're close to being at credit spreads for the corporate sector that are very close to the pre-pandemic levels. So that's the good news part of it. But what I wanted to talk about more is the cost of this crisis and the longer term implications. And the key question that I continue to receive is, why has there been such a disconnect between the financial markets, where they've been rallying so strongly, and what the real economy problems are? So the first thing I would say about this crisis is the key thing that did stand out were really three things. First of all, the synchronization of the crisis. You had every economy except for China really exhibiting negative growth. So we have the economy contracting 4% this year, growing 5% next year, but China was the real exception. China was able to grow by positive 2% this year, and we have China's growth at 8.6% in 2021. So China actually has overtaken the Euro area to become the second largest economy. This happened even before the pandemic. But even if you take a look at the United States, China was about 2/3 the size of the US economy. But with the US contracting, China growing positively, China's growth at 8.6% next year, we actually have that China will be 80% the size of the US economy. So the first thing that stood out about this crisis was the synchronization. The second thing was the speed. You had a very abrupt downturn of the market, and then you had almost as an abrupt an upturn of the market and normalization of conditions as you saw just incredibly extraordinary fiscal and monetary policy put into place. And I just want to highlight some of the numbers here because this goes into just the discussion about the longer term consequences. So if you take a look at what central banks have done during this crisis, we estimate that for the G10 countries, they've expanded their balance sheet by $8 trillion. Half of this by the Fed. And so if we take a look at aggregate for the G4 countries, for the US, for the Euro area, the UK, and Japan, we're actually looking at a 17 percentage point rise of GDP in the balance sheet compared to 6% of GDP during the 2008 global financial crisis. But it wasn't just the balance sheet expansion. If you take a look at the fiscal thrust that's been provided, you've had a record fiscal increase as well. I mean, taking a look at the United States, it's actually the largest fiscal deficit we've had on record in 84 years, about 14 to 16% of GDP, depending on how you measure it. But you had a fiscal thrust that was, nearly 5% of GDP. And if you look at the increased debt, we've had an $8.5 trillion increase in debt levels for government debt this year. Now, next year, is this going to continue? Is this sustainable? What's the long-term cost of this? We think you're going to get balance sheet expansion and fiscal expansion that's about half of that amount. But so the point I would make is just that this has been a crisis that has had an enormous cost to it. And the message I would leave, so the speed of this, the synchronization of the crisis, but also you had a very uniform response because of the 2008 crisis. You had a toolkit that was already in place. And so the ECB did whatever it takes. The large-scale asset purchases, the negative interest rates, the more aggressive forms of forward OMT, the TLTROs, and they also, had to in 2008 create all of this from scratch with the European Stability Mechanism. It's gone beyond that with the European Recovery Fund. It's accelerated some of the talks about having more of a fiscal union. So you had a toolkit in place both by the Fed and the ECB that they were able to activate very quickly. And this meant that you really didn't see the financial market spillovers that usually accompanying crises happen. So, so those are the two things that really stand out. But the third thing that I would just really say about this crisis is that it's incomplete. Incomplete is the word that I would leave you with. So, our economists see global GDP by the end of 2021 still about 3 full percentage points below the pre-pandemic path, or about a 2.5% output gap. Now, that's actually larger than we've seen, in any recovery cycle over the last 50 years. And taking this to Italy, we see an output gap that could be in place for 4 to 5 years. So, you still have serious consequences from this crisis, from what it means for potential growth, given the debt and the fiscal burden, but you had a much faster response by policymakers to put support in place. You had a toolkit that was effective, and you've had a financial market actually be able to withstand this crisis, and that it did not become another source of instability in all of this. But we do think that the ECB will continue to need to take more action going forward. The crisis has brought back financial stability, but it has not brought back inflation. And we still have inflation being, well below target for the next couple of years. Even by 2023, we think that the core inflation level will only be 1.2% annualized. And that amount of low inflation, I think, will require another round of easing. So what we have in our forecast is, we had the ECB meet, earlier this month, but we think it's another $250 billion for the pandemic emergency program. We think there's another 500 billion of asset purchases that will probably be announced in September. We think another round, the 250 billion for the pandemic emergency program in June. These emergency measures and extraordinary measures are going to need to remain in place. And so that just goes through, what is different about this crisis, the synchronicity, the speed of it, but also the magnitude of the policy response, the rapid nature of it, and the fact that financial markets were differentiated in all of this. Going ahead, I wanted to talk about some of the longer term consequences, because after crises of these natures, one thing that we really do take a look at is what are the aftershocks. And the Eurozone crisis was in many ways one of the aftershocks after the 2008 financial crisis. So when we look at the aftershocks that could lie ahead, we see this possibly playing out in some of the emerging markets countries that are not China, not the Northern Asian countries, but countries like Brazil, India, South Asia, Latin America, that are large, major emerging markets countries, but they've had a much harder time managing the second wave. They've had they're having many more challenges to distributing the vaccine. The other unintended consequences we do see is a rise in inequity. And we do see this affecting female participation in the labor force. And you can actually see this very clearly in the gender statistics. In the United States, you had female participation in the labor force before this at nearly an all-time high, like 76.5% participation. You actually saw that drop from January just to May, the 3 percentage points, coinciding with the school year calendar. It went back up in the summer, and then it came back down in September. So you have women very much concentrated in the services sectors, whether it is retail, restaurants, the healthcare sector. And so this is a recession that has disproportionately hit women more than men. Just looking at the World Bank numbers, in high income countries, 90% of women are in those jobs. It's only 64% of men that are in those jobs. So in the rise in inequity is one thing that we worry about. We worry about the slower growth that lies ahead. We worry about that in some of the emerging markets countries, you have a much larger output gap as well. But I would just say that what underpins our assumptions and the way that we analyze this is that we do see a vaccine being available for more widespread distribution by the third quarter of the year. So we start the year slowly and have it gaining momentum. So the key risk here is when you will have the vaccine available, how effective will it be? And will you get through some of these logistical challenges for distributing the vaccine, which requires 2 dosage, very cold temperatures to transport it, and is something where it seems to me before you will have widespread usage, you could be well into the third quarter of 2021. So there is good news ahead, but it is still an incomplete recovery. It's still very dependent on the distribution of the vaccine. And the key thing that we've really looked at is which countries have been able to break that link between mobility and COVID-19. And really, so far, the only country has been China, that's been able to do that. So we had a 9% contraction of the European economy when you had the second lockdown. We had the US economy contracting 1% in the first quarter, but the vaccine brings brighter prospects. So let me end there.
Thank you, Joyce, for this very interesting and wide macro picture. I have to say that we are running a bit late and we have very tight time constraints because some of the speakers of the next section have to leave. So sorry if I will be quite rude with some of you, but please stay within your time limits, and I will stop any kind of introduction besides just announcing the next speaker. So thank you, Chad. And we now move on to Laura Nateri. Laura is head of Italy of Lazar Asset Management. Before that, she was in Aberdeen, asset management, Credit Suisse, BNL, BNP. Laura holds a master in economics and business at Louis University in Rome. And Laura, the floor is yours for your speech. Thank you.
Thank you for the invitation. I will try to stay short, conscious of time. Thank you. I would like to start thinking about the impact of the crisis on our industry, asset management. And I would like to start with a positive view, because a recent report on asset management of The Economist recalled the concept of money doctor, that actually was a concept introduced well before. But, you know, based on the fact that most people have little idea to how to invest, just as they have little ideas how to treat health problems. So it's about trust and giving people the confidence to take on investment risk. So I like the idea we can be money doctor, but let's move to the impact, the real impact. It's clear that in a zero or negative rate environment, and with the huge amount of liquidity in the banking accounts that this year only in Italy will reach the level of the GDP, the need to allocate capital is key. But because the pandemic really is driving some change, probably forever, we as asset managers has to be able to capture the new trends and that will be dominant in the future. So let's focus. I think that we have three challenges to address to reshape properly our industry. The first is innovation, and recently technology save our day-by-day life probably, but also ensure business continuity. And actually, most of the asset management company at global level were ready to remote working and implement technology at all levels, and also leverage the situation to reinvent and redesign the business model. So one thing is changing in particularly fast, that is language and instrument that we can see probably, and this is a new trend, as a preparation of the ground for next target client, millennials. The share of wealth is still small, but it will grow. In the next decade, we will assist to a shift from the baby boomers to millennials that is around 30 million, but trillions of wealth only in the USA. And millennials have different preferences and needs. So tailoring innovative solutions to millennia will be crucial for us to ensure a sustainable growth of asset management. And this also relates, it's very important, to the second challenge. So innovation in terms of technology, business model, solutions, but also competencies. The new challenge is competencies, because we realize that actually the dominated research and analysis model that we use for decades seems now no more able to predict and understand the evolution, development of the market. So introducing in our investment processes new instruments and tools like artificial intelligence, networking theory, or new science that are able to better catch the structural change in society and economy is a must. And if I think to our solution team, it's the most diversified in terms of geography, background, skills. We have a group of data scientists that is probably the fastest growing team in the company, showing that new skills are required to be a game changer in our industry and make the difference. And for active managers, be different became crucial to compete with the giant pacification. Now, I'm very interested in competencies, because the crisis put disposal a huge amount of resources, of money, that we can drive to key areas as education and research. And I'm very happy to be here because Giovanna is, you know, for sure a supporter of education in international education. So, in particular in Italy, we are well behind the curve. So, invest properly. The resource we have at disposal in this moment could be a great opportunity to include large parts of the population, women, that we heard also from Joyce, that for sure could be the most impacted, but also young people to accelerate the development and the growth. And the question is, are we doing enough? We will be able to catch this opportunity to reallocate resources to one of the most important drive for growth. Let's see. From our side, of course, we are working hard to attract and retain talents, improving diversity of our people, ensure gender equality. Most of these are already SDG, Sustainable Development Goals on the agenda of 2030. Number 4, quality of education. Number 5. And this introduced the third real challenge that all of us are discussing, and actually all the speakers mentioned in different way, that is sustainability. ESG, environment, social and governance integration has been on the agenda of the asset management industry since years. But the pandemic shock highlighted that is not a trend at all, but is a need where we can also make the difference. Corporate governance, indeed, the G factor, has been embedded in the investment philosophy of active manager since ever, probably, because engagement and stewardship are the heart of our research. Our mission is to pick the best company, ensuring that they can be sustainable in the growth and profitability, taking into account the need for all the stakeholders, not only the shareholders. Stakeholders are employees, providers, society, collectivity. And proxy voting is a powerful way to influence the company to better behaviors. So we, as an asset manager, have a big opportunity to change in a better way the world. And this is improving anyway, because we have some statistics that show that if in 2017 we as Lazard vote against the manager of the companies we are invested in 47% cases, this number was 43% in 2018, and in 2019 only I mean, it was reduced to 30%. So also the companies, the manager of the company are more and more including better resolution, also considering the needs of all the stakeholders. I have, and I'm going to conclude to leave the time to the other, that if the environment is the priority for companies, states, also central authorities, there is no planet B, is traducing in a strategic decision at different level that hopefully will accelerate with the involvement also of big missed players as US and China. But the E is necessary, but not sufficient. I would like to conclude mentioning the S, the social of ESG, that actually also Corrado, Joyce, but also the professor in terms of inequality impact of the crisis recall. And the S is the weaker part of ESG implementation. In the recent crisis, if the recent crisis provided to the planet in terms of some benefit, if you want, in terms of social impact, the inequality effect actually probably have to be we have to still to see the worst impact in terms of social. So managing the pressure coming from social issues would be the only way to close the circle of sustainability. And I think there is a magic word that fits with all the above, that is inclusion at all levels, because simply inclusion reduces the risk of reduce the risks in general and reduce inequality, accelerate innovation, because involving young people, women, and diverse people just improve creativity and innovation, and ensure sustainable development. So to conclude with a positive view, the pandemic shows some clear directions I think we had to follow to exit the darkness and change the world for the better future. Individual responsibility is the first step, and we see in this month how it was important to start moving on. And I can just ask all of you to do our best to contribute in this way to the secular challenge. Thank you.
Thank you, Laura. Thank you very much also for staying nearly within the limits. So we move on directly to Alessandra Losito. Alessandra is Managing Director and Country Head of Italy at Pictet Wealth Management. Before that, she worked for Citi and Italian Stock Exchange. And I mean, the floor is yours. Sorry for the brief introduction, but we have no time. So thank you, and thank you for staying within the time.
Thank you for having invited me. I will talk about trends, and because COVID-19 has been named by McKinsey as the great accelerator, as several trends have been boosted during this difficult year. We can summarize this megatrend in three categories. The first is innovation. The second is social changing in world population, and the third is focus on ESG, and also Laura Nateri mentioned. Regarding innovation, we can say that innovation is the mother of all the trends. And according to our senior economist, Christophe Donnet at Pictet Wealth Management, there are 7 sources of innovation in the next years. Internet of Things, smart materials, automation, energy, big data, life science, and transports. This second wave of innovation will bring new products and new services. And we think that the challenge between the US and China is related to innovation. So it's also a big challenge and also a big opportunity for Europe and for Italy. The second pillar of megatrend is related to social changing in world population. First of all, world population will be 8.5 billion by the end of 2030, and there will be 2.1 billion people over 60 years old by 2050. So this is called the silver generation. And the challenge, as we also seen this year, is not only increasing life expectancy, but also making these extra years happier and healthier. So also in this trend, we can see problems, but we can see also opportunities. The third pillar is related to the rising of a new consumer, the emerging middle class. This is something that probably we should focus on. In the next years, there will be, and the middle class will rise from 3.6 billion to 5.3 billion, according to Bank of America. The 19% of this growth will be in Asia. So we can understand the big opportunities for investors and for entrepreneurs, also in Europe and also in Italy. And the last trend is, as already mentioned, the ESG. And in particular, the focus is on climate change and environmental issues. An interesting point is also the first reason of the global philanthropy. Is focused on climate change, so it's a very important issue. And there will be $20 trillion will be invested in the market in ESG investment, And we all know that also the recovery plans will be focused on green. So companies will do their part also in terms of ESG, because we know their reputation will depend not only by products and services, but also from the several behaviors towards employees, local community, society at large, and also physical environment. So thank you. I use less than 10 minutes, so we can also come back to the other speakers.
Thank you very much, Alessandra. I mean, you were, I mean, the flashiest of flash. But I mean, what you said was really interesting and very much to the point. I don't want to use the time you spared, so I just leave the floor to Gianluca Serafini. Gianluca Serafini is Chief Executive Officer and General Manager of Fiderum Investimenti SGR, and is Head of Investment Center of Fiderum Intesa Sanpaolo Private Banking. Before that, Gianluca was at Merrill Lynch, Assicurazioni Generali, and he's also an academic because he is a joint professor of private banking at the LIUC, which is the Carlo Cattaneo University in Northern Lombardy. So, Gianluca, the floor is yours.
Thank you very much for having me here. When the COVID-19 pandemic started to spread last March, it was immediately evident to market analysts that the consequence of the economic activity would have been of an abnormal size, both in terms of rapidity and geographical diffusion. Governments adopted severe measures of restriction in social interactions and mobility, causing really the deep decline of the global growth. One of the fundamental macroeconomic indicators, the US occupation, gave evidence of the contraction of the economic activity. Last April, it registered a decline of 20.5 million units compared to the previous months. I mean, if we consider this data, we could well understand how dramatic the negative impacts of the epidemics were. Even after the Second World War or during the Great Recession of 2008 and 9, the US never registered a so deep decline in employment and payrolls. I mean, according to this global situation, making prediction of the consequences of the epidemic became quite hard. Even the most drastic forecasting models started to give quite reliable and unstable projections, both for the short and for the long term. An example comes again from the US occupation. After the large decline in April, the market consensus was expecting a further fall in employment of around 7.5 million units for May. Instead, the following gradual reopening process led to an increase of a payrolls of around 2.5 million. This was a forecast mistake of 10 million workers, despite the help coming from the new techniques and indicators based on big data. What I just have described above suggests how the abnormal decline of the economic activity at global level in the first part of 2020 has certainly represented the resilience test for the financial sector. I mean, a few months after the start of the pandemic, and with an eye on the way out from it, I can try to assess, at least in a preliminary way, how we have coped with this test. I mean, let me start first this assessment with the perspective of the company I work for. As the leading private bank in Italy, as well one of the main players at the European level, we manage a very large share of the saving of Italy's wealthiest. Sincerely, I could say that the very negative impacts of the epidemic on the ability to collect savings from our client have been limited to a few weeks, mainly from mid-March to the mid of April. Behind this outcome, I can say there are three main macro drivers. Of course, weakness consumption related to increasing savings and positive performance of financial markets at global level, despite the COVID-19 spread. I mean, the last point relates more to the fact that the financial markets quickly started to consider the impacts of the epidemic as short-lived and manageable over time, despite the intrinsic and large uncertainty perceived during the subprime crisis when market structure and functioning activities were really dysfunctional. The stabilization of financial market after the spreading of the pandemic has also featured a large political component, especially in the euro area. I can say that for the first time, the European Commission, led by Ursula von der Leyen and the ECB, adopted an exceptional easy monetary policy combined to a centrally designed fiscal support oriented to those member states most impacted by the crisis. Thanks to its monetary policy, the ECB stabilized the government bond markets and the credit markets, thereby avoiding any market disruption. I mean, what is remarkable here this time is the integration between fiscal approach on one end, adopted in addition to monetary easing, the use of the EU budget, and the aim to achieve medium to long-term objectives in terms of improvability to growth. I mean, we could consider, in a sense, that the above 3 points as an extraordinary way out adopted in a moment of global crisis. According to it, we could even consider the pandemic as an exogenous force, bringing about and accelerating a positive change in terms of financial, monetary, and fiscal integration inside the EU. For instance, the ECB support the credit market ensure the banking sector to provide financing forms to firms, even with government guarantees if requested. This could be one example of the new and more effective mechanism that are like to survive the epidemic and will be quite helpful in case of new emergency. If now we focus on the banking sector, we can argue that the changes that have taken place since the financial crisis have made the sector more resilient compared to the past. For instance, we can see the core of the Tier 1 capital that the banks are obliged to set aside to back their business and reach 14%, while the minimum requirement is from the regulators is 8%, 10.5% for Italian banks. As a result, such a high level of capital represents really sizable a buffer for banks to cope with negative shocks for an extended period. Moreover, in these difficult months, we have noticed how non-financial firms have recorded an increase of their liquidities. This is proof from an exceptional high level of bank deposit held by large corporates, which relates mostly to unpaid or undistributed dividend this year. This is a massive amount of 1 trillion euros. On the other side of the Atlantic, the election of Joe Biden as new president makes probably part of the exceptional nature of the pandemic. The change in the White House appears likely to move international relationship back towards a more multilateral approach disliked by President Trump. If it would be so, EU could benefit also of the US support to its Green Deal program as done before. Finally, also the technological sector has shown its positive reaction to COVID. It has registered, in fact, a deep progress related to a large increase of capitalization and earnings. The US and Chinese stock indices have performed extremely well, thanks to some companies of that technology field that have managed to increase revenues and stock prices on their innovative ability. Actually, the most original product of such a technological firm, such as Facebook, Amazon, Apple, Netflix, Google, are basically digital platforms that could be seen as delocalized states whose power and influence have exponentially developed over the last few months by the pandemic emergency. To sum up, from the financial point of view, the epidemic is strengthening the disrupt of some innovative process that has already started but are now become far more evident. It's showing the resilience of the financial system thanks to the intervention adopted after the previous financial crisis. Has started a significant process of deglobalization, for instance, via reshoring of production activity that will affect the trade. Makes imperative to work respecting the concept of environmental protection, social cohesion, and redistributive policies, as well as effective governance, both public and private. So if we look in the past human history, we are not able to find similar condition or model of approach adopted. The only thing we could understand is that when an unexpected event occurs, the way of approaching may depend on the actual specific conditions. I mean, the ongoing pandemic is reminding us that we don't know what, when, where, and how the next major unexpected event will take place. On the contrary, we know our aim to build financial, social, governance, and environmental systems more resilient, efficient, and sustainable. With such ambition, the measures adopted to tackle the unexpected will have medium to long-term positive lasting impacts. Thank you.
Well, thank you, Gianluca. I'm really so sorry I cannot comment. Maybe you don't need it. Absolutely, nobody needs it. But I would like to comment on your speeches. But really, the time is really killing us. So I prefer to leave again the floor to the next speaker. The next speaker is Alessandro Baraldo. Alessandro is CEO of Banca Aletti, private bank of Banco BPM Group. Before that, Alessandro has been the CEO and General Manager of Amundi. He has worked in several positions for the Intesa Sanpaolo Group, for Capitalia Group, Unicredit, and Finanza del Futuro. Alessandro holds a degree, first class at Università La Sapienza in Rome, and he's also an academic, as he's a adjunct professor of financial economics at Università di Torino. So, Alessandro, the floor is yours. Thank you.
Thank you, Umberto. Good evening to everybody, and thanks to Riccardo and Giovanna for inviting me. And I want to start highlighting the fact that when the going gets tough, the culture is even more important. And I believe that this web conference is another pillar that the Herbert Simon Society is going with this so important purpose. So thanks to everybody. So very briefly, I will use a presentation to highlight the reason why I believe that there is something good inside. So I agree with Professor Schäffrin and for you the reason why using this presentation that I'm going to share. So just confirm to myself that the presentation is alive. We highlighted already that, of course, in this particular phase, the monetary policy had a very important role. So the effects are already known. First highlight is that if we look at the yield curves in the US, there's been a rebound. So anticipating the rebound of the economy, I agree with JP Morgan that 5% global growth will be the right forecast for the next year. And starting from US, we see a steepening of the curve due to the strong intervention, also the rebound of the market since March this year. If we take a look at the same picture of Europe, we see that at the same time, the rebound of the equity market was not so strong for a macroeconomic reason, and as well the interest rate curve moved down first for growth, second for the strong PEP and from the strong unconventional monetary policy intervention of the ECB, but as well also because there is, for the first time in history, it's not the Serenissima, but it's the first time in history that we have a union approaching with the European Union a common debt issue. And this is something definitely so important and supporting for the market in the next future. If we look, we already highlighted together how big are the balance sheet of the Federal Reserve on the left side and the ECB on the right side, and we look at in US the strong correlation between the dimension and the growing of the balance sheet as well of the equity market, is not the same exactly in Europe, but this is the starting point to highlight what else. Of course, the effects coming out from this particular environment, and so this approach of the ECB, is true that the euro security total amount available are growing and grew very, very fast, with a tremendous global amount, but at the same time, if you look at financial loans, there is no the so expected immediate transmission to the real economy. This is a good new half glass. The half empty glass is that there is two, I call from a behavioral point of view, guardian approach, and I will talk about guardian approach later on. So if we look effectively to such a strong growth of the money aggregate broader indicator, and then we look at the M3, and then we look at the loans indicator, we see that from one side we have a strong liquidity into the system. From the other, we see that in the liquidity available on the system and current account is less, and of course the use of loans is even lower in the euro area. So this is the opportunity for the fiscal policy, as we already said, to intervene and be more effective. Of course, 11 trillion, globally speaking, it's a huge amount. We expect from all over the world, this total amount will increase about 3 to 5 other trillions. That means full for the economy. But as we have said in the beginning, and Riccardo said, we need to tackle risk factors with the new approach, and from the other side, behavioral analysis in order to implement for the industry, for investors, institutional and retail, some forecasts that will be sustainable and robust in time. So what we have done with our internal model is to highlight on systemic risk indicator and a liquidity risk indicator, and the evidence are, first, the liquidity risk indicators through time. From our analysis, the evidence is that in the different crises, so through the different crises, we are here now, so we are in at the end of 2020. Can we consider, so the red line, the smooth liquidity index, proprietary index, says that the situation can be worry, there can be an issue, but it's not high like in past during the Lehman crisis. So there is room, and we believe that the first and most important corporate bond market that I remember to everybody increased with a tremendous amount, 1.7 trillion, the biggest ever in history, is still there, is liquid, and the central banks will provide liquidity to this market. So at the end is not definitely an issue, but we have to monitor that. And in particular, if calculate the contribution of the different elements, financial, indicators, credit indicators, monetary indicators, and as well the interbank markets, the role of the Fed is definitely very effective. So it's a time to look at the retail credit market. We expect an increase of NPL and UTPs in the next time, but it's possible to manage with the intervention and liquidity provided from central banks. Risk factors means also systemic risk factors. So we implemented our model apart from the traditional financial variables, so risk appetite and excess volatility, also with macroeconomic variables like all the factor models do, but as well with the sentiment variables like market sentiment, economic sentiment, and others. We determine the so-called systemic risk indicators, also thanks to the paper and work of Ollo and other economists. And we believe that the blue line here represents definitely an opportunity because we are under averages, static and moving averages. So there is room, even if there is a third wave due to pandemic and a possible slowing of the economy, there is room definitely to increase position in equity and credit of quality. Just to conclude, two other considerations. So first, if we look at the global crisis in time and behaviors of investors, what is evident here is that, like for instance, during a Lehman crisis, and there was the sell-off during Lehman crisis in 2008 due to panic, but at the end the market rebounded much more than the sell-off during the crisis, and this was true all the times. If we go to the actual situation, is even more evident. So if we make a comparison, the orange line is the global financial crisis of 2008, so Lehman, and COVID-19, so the actual situation, and we make a comparison between the two, is once again the lesson from behaviors of investors, institutional and private, is to have a different approach, more and due to this analysis and evidence, we strongly believe that we have
It's myself or?
No, there's a problem.
Okay.
I cannot hear you, Professor Varaldo.
Alessandro, we cannot hear you. And it wasn't me. I was not cutting your speech because of time constraints. So we cannot hear you anymore.
Even if the microphone is on, so normally it should work, but
no, we cannot hear you.
Umberto, I think we have to move on because the time is really short, and otherwise there will be a mess. Okay. I'm so sorry for Alessandro. We will invite you another time, okay? So you can finish your speech.
Maybe if you can stay with us.
Maybe at the end. Okay.
Yeah, at the end, if you can, finish your speech at the end. So we have to move on very quickly to Zeno Rotondi. Zeno Rotondi, senior industry expert, capital structure advisor at Unicredito. He holds a PhD in economics at the University of Southampton. Zeno is a long-time friend of ours, and because of that, he has to be very, 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 very strict on time. So please, Zeno, go on and be short. Thank you.
Okay, thank you. First, let me thank Giovanna, Riccardo, and Umberto for kindly inviting me to this interesting webinar. In my speech, I will focus on the corporate sector and underline some positive differences of the current crisis with respect to previous crises. Actually, I found at least 4 positive and distinct elements of the ongoing crisis. First of all, the corporate sector is in a better shape now than it was on the eve of the global financial crisis of 2007-2009. In particular, for instance, in Italy, the manufacturing sector is flexible, and already since the sovereign debt crisis of 2011 and 2012 has rapidly recovered competitiveness, bringing the balance of payments into surplus, and the level of indebtedness of firms is below the European average. A second nice thing about this crisis is that this time we have unprecedented policy measures introduced to support the corporate sector. In order to limit the recessionary impact of the COVID-19 shock, the ECB and the governments in Europe have thrown a liquidity lifeline to the corporate sector by introducing emergency measures to inject liquidity either directly or through the banking system, mostly in the form of loans or credit guarantees. Moreover, European governments have enacted measures to facilitate the capital strengthening of firms. A third positive element is represented by the increased use of supply chain finance. The outbreak of COVID-19 caused disruption to supply chains on all continents and across different sectors. Anecdotal evidence suggests that during the pandemic, corporates, both small and large, have structurally increased their use of supply chain finance, systematically considering how to support smaller suppliers' working capital needs. It has also accelerated supply chain finance digitization. Thus, the crisis has highlighted the role that supply chain finance can play in helping firms to increase liquidity and free up cash flow, and by doing so, to improve their resilience to shocks of both their organization and those of their suppliers. And finally, a fourth positive element is the increased resiliency of environmental and social stocks during the stressful times of the COVID-19. During the COVID-19 market crash, firms with high ESG ratings have experienced relatively less negative returns. This finding is inconsistent with the idea that the unprecedented and novel risk posed by the COVID-19 has distracted investors' attention away from environmental and climate issues. Rather, investors, especially those with a long-term orientation, appear to have rewarded responsible initiatives on environmental issues such as the reduction of environmental emissions. Moreover, investors' awareness of environmental and climate issues is much more pronounced today than it was in 2008. In this respect, the Conference of the Parties Agreement of Paris in 2015 may have played an important part in raising awareness on climate issues. Whether the ESG scores capture real commitment is still a big open question in the literature. However, in the face of a shock such as COVID-19, we can better understand how to interpret these scores. This new evidence supports the view that consumer and investor loyalty play an important role in making high ESG firms more resilient to massive shocks. I stop here. Thank you for your kind attention.
Thank you, Zeno. Thank you for a very interesting and very short speech. Thank you to all our speakers. I mean, it has been a very wide and comprehensive analysis of what is happening, and also some lights of optimism came from the different speeches. I now leave the floor to Giovanna for the coordination of the third session of our webinar. So Giovanna, it's up to you, and the floor is yours.
Thanks a lot, and it's time to start the third session of this conference. I will keep to the bone whatever I was going to say, so I will skip it, and I will simply say that the panelists will address how and whether the new normal will require profound changes in the extant rules to assure inclusion, effective market functioning, and I will say some more skin in the game. So I leave the video to Carmine Di Noia because we make it. This is a commissioner's consul who will watch the theme from the perspective of savers and investors. Carmine, the floor is yours. I hope that you're still there, okay?
Yeah, thank you. Can you see me? Yes. And
yes.
Okay. No, great. Very shortly, because I'm really sorry, but I have then to leave at 7:30. Now, the topic is new rules for the new normal of financial markets. Now, I would say my answer, and by the way, these are my personal views and not necessarily that of the Commission. I mean, do we really need new rules? I mean, let's say, I think not. Okay, maybe we need just new ways, to draw up and to enforce them. As this conference shows, maybe it's not the topic of regulation, it's topic of enforcing, the schedule, for example, and maybe this is also market failure. So we understand from the conference that we had a problem with the private enforcing, so that's why public rules and public enforcer maybe are better to keep us in all the schedule. Okay, so we had a lot of EU post-pandemic initiatives that recently launched or updated by the European level, and so maybe this is interesting also for our non-EU guests and speakers. But actually, and so they want to address all the main problems that came up also with COVID. Now, I mean, we say post-pandemic, but actually many of these initiatives were set up, before the crisis. So the CA Capital Markets Action Plan, the FinTech Action Plan, so MiFID review. So, I mean, either let's say we are, lucky or maybe, visionaries, but maybe this is simply the thing that, this is the new normal. So it's just only, an acceleration of existing trends. Now, what's the impact of some of these, I would say, proposals that were already there on, the relationship with, supply and demand, so investors and then corporates. Okay, we're having obviously, and we have discussed very interesting also presentation at the beginning, all over the world, but in Europe, unconventional, monetary policy, very, lower for longer interest rates. And so basically, retail investors in general, and we had important institutional investors before, but retail investors in search of, higher returns, which basically, I mean, for many of them are unavailable. Why? Because basically these are accessible only for high net worth individuals, and also previously, private banking market was mentioned in Italy and so on. So we basically need to increase retail participation on the one side to markets in general, and then on the other side, it may seem strange, especially from a securities regulator, I would say to private, illiquid markets, okay, under the appropriate protection regime. So we need, okay, with diversification, but what this is a question of, I like to say, of financial democracy. So, okay, we need, especially in a world of very low interest rates and very, and high fixed cost, we need to allow people with investor protection to be there. Okay, MiFID review is there. We need obviously people bottom up to understand what they are, buying, okay, in a proportional way. But on the other side, try to accommodate their participation to the market. Actually, MiFID review talks about having a new, let's say, investor categorization. Maybe some sort of certification for, financial advisors. So having some sort of other labels that would allow more participation, direct or indirect, well advised or by yourself. Actually, we just issued our 2 papers, actually. Consob every year is publishing this, kind of research on retail participation, which is important. On the other side, obviously, we have increased, government and corporate indebtedness, and we need to increase the recourse to equity markets, okay, because otherwise, in order to rebalance also the position of corporates. And so, again, we are having since many years, the idea, but also the attempts, and then, okay, we're having a quick fix for those of you who are following the the regulatory debate on how to try to simplify some of the rules that would support access to public markets by listed companies. We had all over the world, but Asia, so US and Europe, a dramatic, reduction of the number of listed companies on the markets. Okay, more money on private markets. Okay, companies going through this called in Europe MTFs, so simplified markets. But we need, we need more there. But also encouraging, more for institutions like many here, would it be banks or insurance, encouraging more long-term and equity, financing from all of them. Okay, there is a lot of debate also on, topic of NPLs, securitization markets. Let me skip it, but maybe another very important issue and other two important, I would say, wave of future, intervention, again, both top down by the EU, but also bottom up by member states and countries and the markets is, digitalization. And so data strategy, I would say data-driven culture, operational resilience. We had the day that the Capital Markets Union plan was presented. We had also the Commission presented the other proposals on the market, the crypto assets, this pilot regime, a sort of EU sandbox, and also DORA, so this Digital Operational, Resilience Act, which are very, very important because, on all sides we have to work on it. And then obviously we have the sustainability agenda. September, we all know 2020 was the warmest month, all over the world and in Europe on average in the history. And for the first time in recorded history, I mean, this is just, a sign, the Arctic, basically, the sea did not ice on the Arctic. So this is, a dramatic, urgency to work on this. We have a lot of, initiatives, I would say, all over the world by many also, I would say, both world public entities, but also private one. We have to try to reconcile these in order to have incentives to go in this direction, given that financial markets are interconnected. Okay, there could be many other things to say. Just to, I would say, to conclude. Okay, we need not more or new rules. We need better rules. Okay, we talk a lot about smart regulation. We need to work more and more on this. Principle should be one rule in, one rule out. We need to maybe use, so-called subtech actually for regtech. Why? Use of technology in rule drafting in order to enable, I would say, regtech in regulated entities. This is very important. OECD, us, everyone is working on this. And the subtech would also make more efficient market surveillance and misconduct analysis. So it would be important for all of us to have more trust on the markets. Maybe at the EU level, for many of you, okay, these are again personal views. I think we need stronger mandate for the ESAs, so ESMA, especially ESMA, but also EBA, EIOPA, to reinforce more and more supervisory convergence, because we have still, despite the use of more and more of EU regulations, which are effective already in the markets, do not need implementation, we still have a lot of fragmentation on the market. Maybe, this could be something more for, let's say, new rules. And I conclude that maybe the pendulum could go for more, I would say, supervisory convergence top-down, so having some more direct supervision, some like we did with the SSM after a crisis. Maybe I would say it's still too, it's too early to conceive on securities market, I would say, a European SEC, so just being at the center supervising all local markets, but certainly it's too late to have only supervision at the local level. So I think that something of it should be found, and maybe not waiting for the next crisis. Thank you very much. I'm really very sorry, but I have to.
Thanks a lot, Carmine. And I need to leave the floor to Giorgio Gobbi, that is the head of Financial Stability Directorate of the Bank of Italy, because he's risking his life to stay inside the building. They are locking the building. So I think you may shed some light on the legacies that the COVID-19 will leave to the bank supervisor. So, Mr. Gobbi, the floor is yours.
Thank you very much. Thank you, Giovanna, thank you to the Herbert Simon Society. I will try to be very short and to address, I'm not sure, I don't know if we need new regulation to adopt the old one or to simplify the old one. I think that we have three main issues that regulators and supervisors should address in the coming months, hoping that the pandemic will be over in the coming months. The first one is, the first issue to deal is clean the wreckage. It has been underlined in several of the distinguished speakers in this conference that for this time, for the first time since a long in history, it has been there has been no second round effect on the financial sector because this has been due because of the exceptional fiscal and monetary measures that have been undertaken. But on the fiscal side, some of these that are credit guarantees, moratorium, and all this kind of sooner or later this will be removed, and there will be gradually removed. And at this point, we'll have the effect on the banking sector. In Europe, talking in Europe, we speak of the banking sector, given the central role of banks in providing finance to the corporate sector. In this case, we will have an increase in non-performing loans. We have been able up to now to prevent this, and we don't know how large it will be. There are a number, a large variety of estimates around. Some are catastrophic, some are less optimistic, but nonetheless, it will be the part of the damage done by the pandemics will be on the once again on the balance sheet of banks. And speaking with the European focus, this time it must be different than in the past time. So we'll have to have some way of to avoid that NPLs pile up on in banks' balance sheet as it has in the past. This requires some sort of adapting. Innovating, I don't know what's the right word, on the procedures in which we have to both regulatory and supervisory procedures. I think, for example, we need to have some sort of network of NPL, national asset management companies, and this also with required to change the attitude of the Commission with regard to state aid, because market prices, that is what has been in the past the benchmark of the Commission in assessing if state aid was there or not, may not be there, the price in the market, because there are asymmetric information, because it's not competitive markets, there are market powers there. So I think that this is one area in how we'll dispose quick and fast of the NPL in the bank balance sheet. The second issue is also regarding the wreckage. That we cannot exclude that some will have some small bank or some banks will have will experience difficulties, and we need to improve the framework for managed banking crisis. Now in Europe, we have a good framework for large banks. We are very cumbersome and not very easy to use for the small banks. That maybe will be the more affected by the consequences of the pandemic. We need a framework that for an orderly liquidation aimed at minimizing the possible risk of financial stability and maximizing the liquidation value. We can learn something from the experience in the US, which is a much more flexible framework. This is the first point. The second point is that we have to adapt, innovate our regulation, I don't know, to the changes that the pandemic has brought about. These changes, some changes were already in the financial industry, but has been tremendously accelerating. And I am thinking of the digitalization of the supply, remote supply of financial services. According to the a recent survey by the European Central Bank, since March, since last March, the 40% of euro area consumer have used payment cards for their daily transaction more often than in the past. And there has been a dramatic decline in the use of cash, banknotes, and physical. This, we don't know, this may be a part of due to the containment measures, but it is likely to be a permanent change in the financial industry. And here we need to update, to innovate our regulation to take account. First, that to have to safeguard market integrity, to to have consumer protection, and to preserve financial stability. So there are the problems that the digital world should not be used for illicit transaction, and I am thinking on anti-money laundering and terrorism, and also we have the cyber risk, the cyber risk area in which we need to strengthen also not only the practices but also the regulation. And also we have up to now the digital world is evolved in chartered area, just payments. It has been used instruments that were there before. We are moving also, when you explore this continent of the digital finance, we are moving in uncharted water. And this is why we have started with, the Commission has started, the European Commission to start to envisage regulation on digital coins and all this area, as it has been mentioned before. Last, and the third point in which, in this case, we need to build a sound regulation is we have to come back to some sort of projects and programs that were somewhat slowed down by the pandemic. That is the climate change risk on the bank balance sheets. Here we have a recent guidelines issued by the European Central Bank, and which just suggest to move from a qualitative to a quantitative assessment of this kind of risks. Here at the Bank of Italy, we have recently published our estimate of the bank portfolio, the loans portfolio exposed to transition risks. That is sizable. And now we have to, once we have built metrics now to measure these risks, it is to incorporate the evaluation of this risk into the prudential framework. There are several, the debate is still open, but I think that there is a consensus that is emerging that this is not a negligible risk. It is a risk that, especially if the public authorities, the governments, will stick to the objectives that have been fixed by the Paris by Paris 2020, and also the commitment recent commitment by the European Council to a very fast and strong reduction, huge reduction in carbon emissions. So we will have a large part of our industries and production systems that will be exposed to this kind of risk. I will stop here for the sake of brevity. So my 3 points are: clean the wreckage, adapt to the change accelerated or brought about by the pandemic, and go back to do the homework that was left behind before the. Thank you very much.
Thanks a lot, Mr. Gobbi, to share the view with us. And last but not least, Mark Yallop, that I thank a lot because he allows me to reshuffle the order of the panel. So thanks a lot. Mark Yallop is the chair of the ICCC Market Standard Board. And I asked him to close the panel with the view on what the risk associated to the new normal in terms of functioning, misconduct, and behavior. Mark Yallop, the floor is yours.
Giovanna, thank you. Riccardo, thank you very much for this invitation to speak. I'm assuming you can hear me okay.
Yes.
It is a cliche to say that the public health crisis and the economic fallout this year created by the pandemic have brought unprecedented challenges. Even after the rollout of an effective vaccine, when that has happened, COVID will change much about life for almost everyone, almost everywhere, and new rules will be needed for the new normal. The human cost of the pandemic has been great, and the sacrifices made by so many people demand that the obvious policy weaknesses exposed by the pandemic do get addressed, at the same time that we can celebrate the policy successes that the pandemic has confirmed. COVID has reminded us of many limitations of conventional economic thinking. To pick just a couple of examples, economic models that rely on the actions of rational agents and take no account of behavioral factors are virtually useless in the face of unknown unknowns. Every day for the past 9 months, we have seen how individuals worried about infection or angry about social restrictions have made personal decisions that have been just as important to health and economic outcomes as government policy. And models calibrated to the tails of the old normal distribution can seriously underestimate the tails of the new normal. Mortality rates in this pandemic are so far about 1% of those in the last comparable global event, the Spanish flu, but GDP losses are about twice as large as seen a century ago. But COVID has also demonstrated the power of preparation. A decade ago, policymakers realized that key financial institutions needed to be resilient to what Ricardo described earlier on as ontological risk. Raising going concern capital and liquidity standards, central clearing of derivatives and securities, new resolution and insolvency regimes have all gone a long way to addressing this deficiency and have made financial institutions hugely safer, even if that work is not yet quite fully complete. And that's the reason why financial institutions are now in a position to play a central role in supporting corporations, institutions, and individuals to navigate their own way through the crisis, rather than themselves needing to be rescued, as happened in the last crisis. But financial market functioning remains exposed to ontological risk. And whether completely unexpected overwhelms market mechanisms, as happened earlier this year in even the largest government bond and repo and money markets, then we are all still reliant on government or central bank interventions to restore liquidity. In other words, the government put, and with it moral hazard, is alive and well in financial markets. It's an interesting question whether markets can be organized in a way that is completely resilient to black swan events and no longer dependent on a liquidity provider of last resort. The fragility of markets in these extreme events is caused by the multiplication of liquidity across complex chains of intermediaries in financial markets. In good times, liquidity passes smoothly along these chains, but in a crisis, pulling liquidity in one part of the market can create a domino effect, accelerating progressively larger shortages of liquidity down the chain and extreme responses in pricing and the availability of liquidity, in the final case, freezing markets altogether. Better understanding these chains and how they operate might allow regulators to redesign market structure so as to reduce or eliminate the government put in markets. And such changes would be great new rules for the new normal if they could be introduced at an acceptable cost. But my hope is that the pandemic is the stimulus for faster progress on an altogether different kind of new rule. As the last crisis revealed, fair and effective wholesale markets underpin fair and effective financial services and products for and the economic prosperity of all the ultimate end users of finance: corporations, institutions, individual borrowers, investors, and insurance policyholders. The trust that these end users place in markets to provide services fairly and effectively, and in governments to backstop market failure, is the basis for social license to operate the leaders of financial services need. Financial market participants enjoy freedom to pursue their business in proportion to the trust that they inspire by acting in trustworthy ways. For reasons we're all familiar with, trust can't be defined or delivered merely by adherence to laws and regulations. Economic crises, if they expose financial sector greed and market manipulation, which in turn demonstrate untrustworthiness, destroy trust, and tear up the social license. This is why the behaviours of those in financial markets are so critical to prosperity, and why FMSB, which I chair, is on such an important quest. Even before the pandemic, the need to codify market practices that demonstrated trustworthiness, reinforced trust, and strengthened the social license was clear. The pandemic has only made this more urgent, not because it's exposed manipulation or malpractice, at least not yet, or because financial services companies have failed to rise to the challenge. Actually, they very much have risen to the challenge, but rather because of the urgent need now for speedy economic recovery. One critical precondition for rapid economic growth is that people and corporations trust financial services providers and markets. Developing a comprehensive set of standards that lay out how business should be done in markets beyond the limits of regulation and the law is one of the most valuable things that we could do in coming years to rebuild trust and to support economic growth. And if that can be done, then these standards really would be valuable new rules for the new order. I am optimistic about the future. Grave as the public health and economic challenges may be, as other speakers have said, there is a lot to celebrate in the adaptability shown through lightning quick adoption of new technology and new ways of working, the resilience shown in the operational response of financial services firms, the sort of wartime spirit shown in the response of individuals. But I think we should go further and use the challenges of COVID as a trigger to accelerate overdue change in the workplace in areas such as employee relations and well-being, diversity, resource allocation, and the advancement of broader stakeholder interests alongside the financial returns to shareholders. As a trigger, if you like, to create new rules for the new normal, not just in business practices, but also in business purpose. The most startling revelation for financial services in the past 9 months, I think, has been how effective remote working has been, despite the universal assumption beforehand that mass out-of-office working could only occur in large, dedicated business recovery or continuity sites. Mass work from home has provided excellent customer service at the same time as accommodating business volumes up to 4 to 500% higher than usual levels. Of course, we don't know if mass work from home will endure, but if it does, there are risks to consider as well as benefits. Among them, some genuinely new risks, unsuitable or shared remote working spaces, psychological pressures on staff to return to office environments, fragmentation of corporate culture, and so forth, as well as some familiar risks that are exacerbated by remote working. But focusing on individual risks like this ignores the root of the issue. How business is conducted is not just determined by the control environment, but also by the culture of organizations. Of course, firms need systematic controls designed to prevent misconduct happening in the first place and to detect misconduct when it does occur. Rules-based controls have their inevitable place, but overly simplistic controls can lead to staff not exercising judgment where that is required, and excessive focus on systems and controls can disempower individuals and potentially poorer outcomes is needed. Firms need also to select and develop the right kind of people, provide them with a high quality guidance and training, opportunities to develop sound judgment where simple rules don't provide clear answers, and a clear sense of the purpose that they have in finance. Individual staff members who feel enfranchised within their firm, who understand their purpose, the social license that their firms enjoy, and are willing to talk about how potential conflicts of interest should be addressed, are more likely to develop better judgment and deliver fairer and more effective outcomes for their customers. It may be that a more diverse workforce is also better equipped to adjust to address novel challenges and can apply better judgment that will underpin fairer and more effective outcomes than a more uniform staffing arrangement. A revolution has been underway in financial markets for some time to deliver a more robust framework that sets out fairer and more effective outcomes for market users based on a genuine sense of purpose, demonstrates trustworthiness, builds trust, and provides a stronger foundation for economic growth and prosperity. This framework should become the new rules for new financial markets. The need for this revolution is intensified, not diminished by the pandemic. The new ways of working that we've all had to adopt should be a call to arms for greater attention to the way that purpose, culture, and competence underpin business conduct. And I am optimistic that the makers of markets will rise to this challenge. Giovanna, Riccardo, ladies and gentlemen, thank you very much for your attention this evening.
Thanks a lot, Mr. Yallop, for the patience and to be with us from the very beginning till the end. So we now are running out of time. I'll wrap up the session thanking you in particular, but all the three of panelists for their thoughtful insight. And finally, let me introduce Gregorio De Felice, the Chief Economist of Intesa Sanpaolo. Please, Gregorio, the virtual floor is yours for the concluding remark. And then we are also receiving some questions from the public that is still alive. I mean, the audience is still there and sending questions. So if there is time, I will turn the question to Gregorio. Otherwise, I will send the question to the panelists later on. Thanks a lot.
Thank you, Giovanna. Thank you for your unbelievable job as a moderator. You saved a lot of time in your session. My main commitment is to make you go to dinner before 8, because I guess your families are waiting for you. So a couple of remarks. The first one is regards to some positive features which allow us to be confident about the recovery next year, 2021. And second, what conditions, under what conditions this feature can translate into new engines of growth. So let me start with some good news in this horrible year. First is the reaction of Europe. EU institutions have shown a capacity to take decisions quite promptly with no comparison to the experiences of the great financial crisis in 2008 or with the sovereign debt crisis in 2011, 2012. So the identity of a united Europe has emerged strongly, much stronger than in the past. The response to the crisis came from the monetary policy. I like to point out that the ECB is financing the huge increase in public deficits in this year. Just to give you some figures, 27% of the Italian public debt, 29% of German public debt, and so on, 23% of French, and so on. Second, the suspension of the Stability and Growth Pact, and the third, the so-called temporary framework. Just a few people mentioned that, but I think it's very, very important. Otherwise, the interventions of single member states would be considered violations of competitions. And the fiscal policy with a series of programs assure the availability of funds from the EMS for health expenses and so on, but mainly the Next Generation EU program aimed at modernizing the European economies and favoring the twin transitions towards a digitized world and a green economy in Europe. A second feature which is very positive to me is the increased propensity to save. It's a precautionary savings, but as the Intesa Sanpaolo Centro Einaudi annual survey on the Italian households shows, the propensity to save is now up to about 20% this year. It was 11.8 before the pandemic and 7.3% 10, 20 years ago. So this is important because now the challenge is that to channel this huge amount of liquidity towards the recovery. In other words, savings will have to go back to work to get a sustainable and inclusive development. Just a small calculation, if only 2/3 of these additional reserves were put back into play next year, they could triple the activation capacity triggered by the recovery fund and make the expectations of a recovery much more realistic. The third feature is the strong Italian competitive position in faster growing sectors. We do not have so much time. Zeno Rotondi mentioned some features. I'd like to point out the environmental transition, where I think Italy has a great opportunity to consolidate its competitive position in a sector which will experience a huge increase in demand in the coming years. What are the conditions to transform these positive features into a strong recovery? First of all, the confidence needs to be revived. With the same global vision of Europe, Italy must identify projects and priorities to take full advantages of the opportunity coming from Next Generation EU. And Next Generation EU shouldn't be an excuse for not correcting Italian structural weaknesses. The action to be taken are well known: enhance the quality of human capital, increase in spending and on research and development, improving the productivity, especially in the public administration and in the justice system. I believe the Italian ruling class must work together to create the conditions for faster and more sustainable and inclusive growth. So when we hear or we read in newspapers these days about the possibility of a government crisis, I fear I'm really very, very scary. Another point which is very important to me is the access to capital markets, which needs to be strengthened substantially. Italian companies need patient capital. Listing on the stock exchange can be the right solution also for the issues such as generational change and dimensional growth. Just think that today, the size of the stock market, of the Italian stock market, is just 0.8% of the global one. And this is a very small percentage if we compare it with the Italian share of global GDP, which is above 2.3%. So we need to improve financial literacy. This is an issue Giovanna and Riccardo and Umberto are very familiar with. But to wrap up, because it's 8 p.m., I think globally we are facing many challenges with many gaps to fill in. There are many risks we are running, but at the same time, we have a great, a wonderful opportunity to reverse, how can I say, a sort of inertia and to tackle all the new problems. We need to look especially at the younger generations, providing them hope for better economic perspectives. Thank you all. Thank you, Giovanna. I see your face. I don't know if you are going to conclude.
Have been perfect.
Riccardo.
No, I'm not. I feel bad because we stopped abruptly the speech of Alessandro Varaldo.
Yes, of course.
Is asking question for him. So I just leave him the chance to answer one question, and then I will give the word to and the floor to Viale to wrap up finally this conference. It's been quite long. So there is a question for Alessandro Varaldo. I hope that is online, is there. Because they're asking something more about the approach Banca Aletti has in using behavioral advisory model. Can you explain a little bit more about that?
Absolutely. Thank you, Giovanna. I hope
sorry for before.
you hear me well now. So sorry for the inconvenience with the audio. So very briefly, to conclude, combine the elements coming out from our risk measures. So as I said, so the liquidity risk that is particularly important today, the systemic risk as well, including forecast drivers like sentiment and like also the coming out from the listed companies news that we bring into, and last but not least, coming to behavior are flows. And we distinguish between retail institutional flows in order to anticipate from one side the possible future movements of the markets, and from the other, we use them to educate others in order to explain in front of some resilience to take risk-on positions, the right attitude according to time horizon, according to risk analysis, and according to our asset allocation output.
A lot, Alessandro. Thanks a lot, and forgive me for before. And we have several questions. All the questions will be turned into the panelists. So I leave the floor for the final, conclusion and some other instruction. I don't know to Professor Riccardo Viale. Professor Viale, the floor is yours.
The next step to the future is to the dinner. The next step, because it's very late. In any case,
you are very right. You're very right.
In any case, I think the result of this seminar is a behavioral result. Since I saw a lot of optimism about the future, then this was not predictable before. But I am very happy that this was one of the result of the analysis. What I may say is that the next meeting of Herbert Simon Society, in particular Be Fairly program, will be in Rome in April to present a national survey on insurance behavior made with Doxa and University Bicocca Milano. And there will be a discussion about what is the culture, the insurance culture, the insurance literacy, and the propension in insurance behavior among Italians. And then I invite you to participate. Probably will be a hybrid, a mixed conference, a little in present, I hope, and also virtually. Then thank you very much for everyone that participated to this interesting and optimistic conference.
Thanks a lot to everybody. Thanks to Gregorio De Felice, that is also someone that stays all the way along with us. And we hope to have other chance, thanks to Umberto Filotto, we hope to have other chance to meet with the Herbert Simon Society. Umberto, do you want to say something?
Just thank you to everybody. It's been a very interesting, I think, webinar, and I share the view of Riccardo and yourself. Also an optimistic view. So it has been a nice way to go into our dinner. Thank you. Thank you, everybody.
We will have a cup of champagne. Okay. Bye-bye.
Bye. Bye to everybody. Thank you.